Did you know that over 50% of individual traders lose money in the stock market? Yet, more people are diving into online investing every day. Why? Because the potential for high returns is huge, but so are the risks. In fact, online trading platforms saw a 250% increase in users between 2019 and 2021, with millions of people now trading stocks, crypto, and more right from their phones. But here's the kicker: 90% of these new traders don't have a strategy and end up losing big. This tutorial isn't just another buy low, sell high lesson. We're going to dive into unique strategies, smart tools, and insider tips that could give you an edge in this fast-paced world. From finding hidden gems in niche markets to using AI to make smarter trades, we'll cover it all. Stay tuned, because by the end of this video, you'll know how to take the risks out of trading and turn volatility into opportunity. Ready to discover the secrets of online investing? Let's get started. Chapter 1. The Digital Gold Rush. Finding gems in the online investing world. Online investing today feels a lot like the gold rush of the 1800s. Everyone's racing to stake a claim in stocks, crypto, or even niche assets like NFTs. But just like then, only a few come out with real treasures. One of the smartest strategies? Look for assets with low visibility but high potential. Take the rise of fractional real estate. Platforms like Fundrise allow investors to buy into properties for as little as $10. Real estate, which used to demand thousands up front, is now within reach of anyone with a phone. Another hidden gem? Green bonds. According to the Climate Bonds Initiative, green bonds hit a record $500 billion in 2022. These bonds not only grow your money but also support eco-friendly projects. For those with an appetite for risk, emerging markets can offer returns that dwarf traditional stocks. Countries like Vietnam and Nigeria have seen 20% plus annual growth in sectors like tech and agriculture. It's like investing in Silicon Valley in the 90s. Remember what Peter Lynch, author of One Up on Wall Street, said: "Know what you own, and know why you own it. Always do your homework before diving into a niche investment." Chapter 2. Chart Whisperer. Decoding price movements like a pro. Reading charts isn't about predicting the future, it's about understanding the present. Every bar, line, or candle tells a story about what the market is thinking. Start with the basics. Candlestick charts are a favorite for traders because they show price movement in detail. For example, a hammer candlestick often signals a reversal to the upside. If you're into something more advanced, try the Ichimoku cloud. It's a Japanese trading indicator that combines multiple data points to give a complete market outlook. Many traders swear by it because it highlights trends and potential reversals all at once. Fibonacci retracement is another tool worth learning. Did you know it's based on the golden ratio, 1.618? This ratio appears in nature, architecture, and, surprisingly, in stock charts. Traders use it to spot key levels where prices might bounce or stall. Statistically, markets trend only 30% of the time. The other 70%? Sideways movement. That's why tools like Bollinger Bands are essential. They help identify when prices are too high or low within that sideways range. As legendary trader Jesse Livermore once said, "The big money is not in the buying and selling, but in the waiting." Learning to read and wait for the right signals is half the battle. Chapter 3. The Psychology Playbook. Mastering the mindset of winning traders. Investing success isn't just numbers, it's about keeping your head straight when things get tough. Over 80% of day traders quit within 2 years, according to a study by the Journal of Finance. Why? Their emotions sabotage their strategies. First rule: never let fear or greed dictate your actions. Fear makes you sell too soon, greed keeps you in too long. Daniel Kahneman, a Nobel laureate in economics, proved that humans feel losses twice as strongly as gains. This is why many investors panic sell at the worst times. To combat this, set clear rules before you trade. Decide your entry and exit points based on data, not emotions. Tools like stop-loss orders can automate this, so you don't have to decide in the heat of the moment. Another tip? Keep a journal. Write down why you made each trade and how you felt about it. Over time, you'll notice patterns in your thinking. This helps you avoid repeating mistakes. Visualization is another powerful tool. Research from the Journal of Applied Psychology found that imagining success in detail can boost actual performance. Picture yourself following your plan, even when markets get wild. Lastly, find inspiration from greats like Warren Buffett. He says, "Be fearful when others are greedy, and greedy when others are fearful." It's simple advice, but only a disciplined mind can follow it. Enjoying the tutorial so far? Don't forget to subscribe for more insights and tips on mastering the world of online investing and trading. Let's move on to the next chapter. Chapter 4. Algorithm Allies. Leveraging AI and bots in your trading strategy. Trading has gone digital, but now it's going smart. AI and bots are reshaping how people trade, making it faster, more efficient, and in many cases, more profitable. But how do you harness this power without getting overwhelmed? Start simple. Automated bots can handle repetitive tasks like placing trades based on preset conditions. Platforms like MetaTrader or TradingView let you create basic algorithms with no coding required. For example, you can program a bot to sell if a stock drops 2% in a day. For those seeking an edge, there are AI-driven platforms like Signally or Stoic. These tools analyze vast amounts of data, news, trends, and even social media sentiment to recommend trades. A 2021 report by PwC found that AI-driven funds often outperform traditional funds during volatile markets. But don't think it's a magic solution. Algorithms can magnify mistakes just as easily as they find opportunities. That's why testing your strategy is crucial. Backtesting, which runs your bot against historical data, helps you refine your approach. Data shows that high-frequency trading, HFT, a type of algorithmic trading, accounts for over 50% of all stock market volume. While retail investors can't compete with institutional HFT, using bots for smaller trades can still be highly effective. Remember what Ray Dalio said in Principles: "He who lives by the crystal ball will eat shattered glass." Algorithms aren't about predictions, they're about consistency. Use them as tools, not fortune tellers. Chapter 5. Risk Alchemy. Turning volatility into opportunity. Investing without risk is like fishing without water, it just doesn't exist. But smart investors know how to turn volatility into an ally. The key? Risk management. First, never risk more than 2% of your total capital on a single trade. This rule, known as the 2% rule, keeps you in the game even if a few trades go south. Position sizing is another critical strategy. Let's say you have $10,000 to invest, and you're willing to risk $200 on one trade. If a stock's stop loss is $5 below its current price, you'd buy 40 shares, $200 divided by $5. It's simple math, but it's also your safety net. Hedging is another powerful tool. Options, for example, let you protect your portfolio. If you own a stock but fear a short-term drop, you can buy a put option as insurance. It's like wearing a seatbelt during a bumpy ride. Did you know that during the 2008 financial crisis, hedge funds that used risk management strategies had an average loss of just 4%, compared to the 37% loss of the S&P 500? Managing risk doesn't just save money, it preserves your peace of mind. Stop-loss orders are a lifesaver too. These automatically sell your stock when it falls to a certain price. As Warren Buffett puts it, Rule number 1. Never lose money. Rule number 2. Never forget rule number 1. Chapter 6. Building your investing fortress. Diversification that works. Diversification is often misunderstood. It's not about owning a bit of everything, it's about balancing risk and reward. A strong portfolio is like a fortress, built to withstand all kinds of market weather. Start by splitting your investments into different asset classes: stocks, bonds, real estate, and perhaps even alternative assets like commodities or crypto. According to Vanguard, a portfolio with 60% stocks and 40% bonds has delivered average annual returns of 8.8% over the last 90 years. Within each asset class, diversify further. For stocks, aim for a mix of sectors like tech, healthcare, and energy. For bonds, consider a mix of corporate, municipal, and treasury bonds. Global diversification is another layer many overlook. U.S. markets dominate headlines, but emerging markets often outpace them in growth. For example, the MSCI Emerging Markets Index has outperformed the S&P 500 in 12 of the last 25 years. Don't forget about income-generating investments. Dividend-paying stocks or REITs, real estate investment trusts, provide steady cash flow, which can cushion your portfolio during downturns. As John C. Bogle, founder of Vanguard, said, "Don't look for the needle in the haystack. Just buy the haystack." Index funds are a simple way to achieve instant diversification. Lastly, revisit your portfolio regularly. Markets change, and so should your mix. Rebalancing once or twice a year ensures your portfolio stays aligned with your goals. If you found this tutorial valuable, don't forget to subscribe for more tips and tricks to take your investing game to the next level.